Hello everyone and welcome back to Finance with JCL, the show here to help you on your investing journey to financial freedom. And today's show is particularly pertinent to that objective because I'll be sharing my portfolio update, my regular update that I provide every 2 to 3 months, to let you know how I'm going on my journey to financial freedom with my £1 million investment challenge. So on with the show for today. The objective is threefold. So I'll first of all start with a refresher of what the 1 million challenge actually is. Good challenge to myself. I'll then share my progress, and that'll give you the opportunity to kind of follow me on my journey. Now the disclaimer is don't blindly copy the moves that I make with my portfolio. It's just there to give you some ideas around my thinking. I'm not a financial advisor, so do make sure that you take your own advice and do your own research before you make any changes to your portfolio. The plan is a long-term investing strategy, long-term investments purchased with a margin of safety. So I'm starting at the start of the year with 20,000. I'm aiming to input 300 a month and then grow and compound that at 6.66% per year. And that should take me to 2061, and then I'll have £1 million in the portfolio. So that's the plan, and what I'll be doing is regular updates every 2 to 3 months to share my progress against the plan, how I evolve my thinking and improve it over a period of time. Now that we can look at the plan, let's look at my progress. So the target for the value of the portfolio for the end of this calendar year 2020 is 24,932. The current value is 24,730, but it's just short of that, and it's 575 more than at the previous update. But essentially the reason that's gone up is because I've made 600 of additional deposits. There's another 900 to go before the end of the year. So therefore, if I look at the current value, add in the minimum additional input to the end of the year, that's given me an estimated year-end position of 25,630, which is about 700 ahead of the end of year target. Now, of course, that could fluctuate based on investment choices I make and movements in the market, but broadly speaking, I'm on track to be where I need to be for this element of my portfolio for the end of this year. Let's look at the makeup of the portfolio. So there have been some changes. So the largest area of my holdings for this is actually individual companies, and that comprises 39% of the value of the portfolio. Now, the individual companies need to match a couple of criteria for them to be in there. So first of all, they need to be a wonderful company at a fair price. That's the main objective. An example of that is Bank OZK. Secondly, I will look at companies that are severely undervalued based on their book value. And I will have a very small element of the portfolio, so I want it to be no more than 5% of companies where it's a bit of a growth play, a bit of a speculative purchase, and I'll keep that to a very minimum part of the portfolio. So the 39% is actually 5 percentage points higher than it was about 3 months ago. And you'll see why in the coming moments when I show some of the changes and transactions that have happened on the portfolio. But where I want to be is around about 40% or so in individual companies. I want to be sort of bonds getting just over 5%, and then a couple of percentage points in the commodities. So that'll be half the portfolio. And then the other half will be the index trackers and cash. So the index tracker is getting towards 50% of that. That's almost a protection against my mistakes, because I have to demonstrate to myself that I can stop pick individual companies. But if I can't do that, if the index trackers are getting on for half the portfolio, that's that protection of getting that long-term 6, 7, 8% return a year. So there's kind of a margin of safety there in my own portfolio. The index trackers themselves are actually 26% at the moment, so probably a little bit lower than I want. So I'm actually down 4%. And the reason for that is in one of my accounts, I had UK Index, so that's UK Total Index Tracker, and I was about 12% up at it, and I sold it all. So I think I'm overexposed to the UK performance and index, and with the virus cases increasing, and then the uncertainty around the Brexit trade deal, I think there's potential for that to have a limited upside in the near term. I think I can find some undervalued companies that will give me better returns. So the third biggest position after individual companies at 39 and index trackers at 26 is cash, which is at 15%, so 1/6 of my whole portfolio. And that's actually up 6 percentage points. I've made some sales, which you'll see on the next section. And the reason I've got quite a lot of cash is I'm just waiting to find some additional wonderful companies, and I'm waiting poised for any indexes to fall, because I want to move a bit more into the American index, for example. I mean, that's pretty high, it's near its record highs, and that cash is poised for such time that that index falls considerably, and there may be some uncertainty around the election, or the virus cases, what have you, and therefore I will enter the market into index trackers for that sector should the levels fall. We get to the smaller positions of managed funds, bonds and commodities. The bonds are 6%, commodities 2%. So the bonds, I'll just keep ticking away there. I think the managed fund is an interesting one at 12%. That's actually down 7 percentage points from what it was previously. And the reason is when I started this journey, I had quite a lot in managed funds. It was actually a much higher percentage than probably looking at into the 40% area. And done a lot of research and I'm thinking about it. I don't think that's the way to go, especially with the fees that they charge, and over the very long term, very few funds beat the market. And I will be putting out a show in the next couple of weeks, one of my biggest investing mistakes, where one of my funds actually returned 127%, but it's actually a big mistake, because had I put it into the index tracker for the market that it was following, my return would have been upwards of 250%. That's a good learning for me there. And the reason the managed funds this time did drop by 7 percentage points to 12% of the portfolio is that a couple of funds that I sold that I no longer wanted to hold, and I was up on them, so just got them closed down, and I'll redeploy the capital. It's currently as cash, but it will go into index trackers and individual companies at the appropriate times. So that's the makeup of the portfolio and a bit of my thinking around it. Now, I thought I'd share perhaps my top half a dozen holdings, just to give you an idea of what's in there. So the biggest holding at 21% in total is index tracker exposure to various elements of the UK market. It's probably a bit higher than I want to be exposed to the UK market. I'd want to have a bit more exposure to the US market, and I'll wait to enter that at the right time. And I'm also starting an index tracker for the Chinese market as well. So I think that the upside potential in the long term there is still significant. Cash, as we saw a few moments ago, is at 15%. That's my second biggest holding, and that's just ready, waiting. I normally wouldn't keep this much cash. I'd normally want it perhaps around 5%, but in these uncertain times, I want to be able to move quickly where I find these undervalued potential equities or indexes. Now, two of my only 3 managed funds are next. So you can see they're 4% for Linsell Train UK Equity. And that's been good. And the reason I've kept that one is I really, really like the fund managers, their philosophy of keeping a small portfolio, looking at these really excellent long-term plays. And then I wanted some exposure to the UK market, sort of the very small organisations where perhaps they've got a lot more growth potential, maybe a bit more agile and nimble. And that's what the ASI UK smaller companies gives me at 4% of the portfolio. Now that one's up about 115% since I got it, so it's been very good. And that's very favourable compared to the overall UK market. So I like what they do in that one as well, so I've held on to those two. Now my biggest individual company, which is my favourite individual company, is Bank OZK at 4 percentage points of my portfolio. I have increased that position recently, and I will do so further if the price remains around the sort of $20 mark. And then Unilever is the 6th biggest position. I've got, again, 4%, and I got into that one, must have been about 7 years ago, and that's actually up about 113% if you include dividends. It's done very well for me. I'm very happy to hold on to that one So those are my top 6 holdings, just to give you an idea of what I've got. And then we'll look at the changes that have occurred since the last update. So as I mentioned, I was a bit overweight on the UK index, so I sold one of those funds. That's up about 12%. Now I then sold National Grid. So I've had National Grid for a long time, although the capital value of it's pretty much exactly the same as it was when I purchased it 5-6 years ago. The dividend return has been them actually about 40% on that one. And I've redone the numbers on it. Thinking the upside isn't so good. Looking at the cash flows, looking at the debt, the interest coverage, it wouldn't be a company I buy now. And I've made a positive return. Don't think there's a massive upside. Looking at the cash flow, so therefore I've sort of cashed in on that, and I wait to look for an excellent opportunity. Similar for GlaxoSmithKline, I think there's limited upside. Looking at the cash flow, I think it's trading almost at intrinsic value, maybe 15% below. So it's pretty much there. And if I was looking at it fresh, I wouldn't go out and buy this company, even though it does have good return on equity margin. It's just the cash flows generates don't justify the price. So I made about 33% over time this one. Not a huge return, but it's done okay for me. But it isn't that amazing, wonderful company. I'd rather sell those two and put more into Banco ZK, for example, which I think is got a much bigger upside to it. So those are the movements out of the portfolio. I have actually bought some things in. So Unum Group, which is American Insurance Group, bought stake in that company, and I think I could increase that position based on my calculations, both in terms of the book value and also the free cash flow generates. I think it's actually worth 3 times what its current price is, broadly speaking. Now, that doesn't mean you can't buy that, that's just my opinion, but I've entered a position and I suspect I'll be increasing that position. Speaking of position increases, as I mentioned, Banco ZK, that position's increased and I'm likely to continue to do so. And then perhaps part of the very small speculative element of the portfolio, I've gone for Seritage Growth Properties as a new position, very small position. But I think the upside, this is one that Phil Town owns, and he calculates the upside as potentially 14 times what the $10 share price was, roughly, when I entered. I've done quite a bit of research on it, and some other YouTubers have created some really good content on this, particularly the Investing with Tom channel, so I'd urge you to check that channel out. He's really done a really good piece on this, and yeah, I've gone in for this one. That's one of my small positions. So that is the end of the portfolio update at the start of October 2020. I hope you found this really interesting, and it helps me articulate my thought process and what I'm trying to achieve. If you want to see more of this or catch my next update, if you hit the subscribe button on YouTube, if you're watching there, that will enable you to be alerted to the next updates that I post. And if you could hit the like button if you found it useful, that would be good, because it will help promote this content to others as well. So thank you very much for joining me, and I'll see you next time.